During the past week, the domestic currency was broadly stable and traded in the range between 75.50 to 75.80 on most of the days. The high and low for the week being 75.50 and 76.10 respectively. The short-term outlook for the rupee is moderately bearish, and we expect the domestic currency to hover in the range between 75.40 to 76.30 in the remainder of this month. The unfavorable economic indicators are neutralized by the strong external position of the country, thus leaving the rupee to remain stable. Due to shortening of trading hours from 10 a.m. to 2 p.m. every working day, the speculative activities in the market have significantly reduced, and only the supply and demand of dollars from the market gauge the rupee's trend. The importers and exporters are advised to hedge their exposures, keeping the above stated range in mind and strictly adhering to the internal benchmark rate assigned for each exposure category. Any undue volatility in the market is managed by the central bank's intervention on the buy and sell sides appropriately. The three major US stock indices posted their worst day on Thursday since mid-March by falling over 5%. Following the decline in US stock indices, the BSE Sensex opened on Friday with a fall of 3.3%, but quite surprisingly ended the week with a gain of 0.72%. The significant recovery in global stocks on Friday was quite unexpected by the market. As the domestic currency is expected to remain volatile, it is imperative for the importers and exporters to strictly adhere to the risk management policy guidelines and hedge the exposures on the BL date against the import payables and on the date of signing of the export order for hedging the export receivables for the anticipated maturity, which could help in avoiding the mismatches between the exposure maturities and the hedges undertaken. To ensure easier cash flow management, we strongly recommend the currency risk managers to crystallize the cash flows on the date of initiation of the respective exposures. Due to surplus liquidity in the market, the short-term interest rates are ruling lower and the long-term sovereign bond yields are declining significantly. The 10-year sovereign bond yield is currently trading at 5.8%, and the central bank's huge purchase of bonds from the market enabled the bond yield to drift lower, supported by stability in the exchange rate and a contracting interest rate differential between the US dollar and Indian rupee short-term interest rates. The forward dropped lower across the maturities. The forward curve beyond the 3-month maturities is demonstrating a steepening pattern at the medium and long end. We expect to see the forward to remain broadly steady at the prevailing levels in the coming week.